right now, the massive AI models that are, generating your text or writing your code or rendering your images,
Right.
they are running so unbelievably hot that they are literally physically threatening to melt the metal racks holding them together.
Yeah, it's wild.
It really is. I mean, we always think of the cloud as this invisible, ethereal thing floating above us, but
Yeah.
today we are looking at the heavy, multi-billion-dollar physical industry that is just racing to keep those massive server farms from, literally catching fire.
Catching fire, exactly. Because it's a real risk.
Welcome back to today's deep dive. Whether you're prepping for an investment meeting, tracking industrial trends, or you just want to understand the invisible architecture of the modern world, this is your shortcut.
And our sole source for today is nVent's first quarter 2026 earnings presentation, which is dated May 1st, 2026.
Right, and I know what you're thinking. An electrical company's earnings deck might sound like, well, a really dry read.
Oh, totally.
But this specific presentation reveals the massive, unprecedented physical infrastructure boom that is powering our entire digital lives.
Yeah, because we so often get caught up in the software side, right?
Yeah.
The algorithms, the user interfaces, the apps.
Real flashy stuff.
Exactly, the flashy stuff. And we completely overlook the massive physical ecosystems required to make those screens actually work.
So true.
So our mission today is to look past the spreadsheets and really understand why this specific company is seeing explosive, record-breaking numbers right now. And what that tells you about the global push for data centers, electrification, and sustainability.
Okay, let's unpack this because the numbers they just dropped for Q1 of 2026 are honestly staggering.
They really are.
We're looking at a record $1.2 billion in quarterly sales.
Right.
That is up 53% overall compared to the previous year and 34% organically. Plus, their adjusted earnings per share, their EPS, hit $1.09.
Which is a 63% jump.
A 63% jump. I mean, those aren't just, incremental gains where a company found a few operational efficiencies. Those are blowout numbers.
Oh, yeah, completely. They indicate a fundamental shift in their market environment.
Yeah.
Because when you look at an earnings report, you always want to look at the forward momentum, right? And nVent significantly raised its full-year guidance based on just this one quarter.
What are they projecting now?
Well, they're now projecting 26% to 28% reported sales growth for the entire year of 2026. And an adjusted EPS of $4.45 to $4.55.
Wow.
Yeah, you don't revise your outlook upward that aggressively, especially in heavy manufacturing where lead times are super long, unless you have absolute visibility into a massive wave of upcoming business.
But wait, let me push back on that forward momentum for a second.
Sure, go ahead.
Because as I was reading through the presentation, one specific number just stopped me in my tracks. A backlog of $2.6 billion.
Yep, $2.6 billion.
I mean, my first instinct when I see a backlog that massive in the physical goods sector is to wonder if, the wheels are falling off the wagon.
Right.
Is a backlog of that size really a sign of incredible market demand, or does it signal a massive supply chain bottleneck? Like, are they simply failing to secure raw materials or fulfill orders fast enough?
That's a fair point.
Because an order on the books doesn't actually become revenue until the hardware is sitting on a loading dock somewhere.
Right. This raises an important question. And looking at the backlog as a potential risk factor is exactly the right critical lens to apply here.
Okay, good.
Because while supply chain friction is, always a reality in heavy industry, the data here overwhelmingly points to unprecedented demand rather than a broken delivery system.
So what's the specific metric in the deck that rules out a bottleneck?
It's the order growth rate. The presentation highlights a 40% organic order growth year over year.
40%.
Yeah, 40%. When new organic orders are flooding into your system 40% faster than they were a year ago, your backlog is mathematically going to swell.
Even if your factories are running perfectly?
Exactly. Even if your factory floors are running at absolute peak efficiency.
Yeah.
That being said, they are aggressively expanding to catch up.
Oh, they have to be.
Yeah. The source actually outlines a capital expenditure plan of roughly $130 million for the year, which is up about 40%.
So they are literally pouring money into expanding their physical footprint. Buying new stamping machines, building new assembly lines, upgrading logistics just to chew through that $2.6 billion faster.
Right. I mean, it's a high-class problem to have, but it requires serious capital to solve. They are scrambling to build the capacity to meet a demand curve that has basically gone vertical.
Which brings us to the next logical question.
Right.
Where exactly is all this demand coming from?
Right.
If you follow the money in this report, it leads directly to their infrastructure segment. Infrastructure now makes up a massive 56% of nVent's entire business. In Q1 alone, that segment's sales hit $895 million,
And that's up 76% overall.
up 76%, and up 50% organically. And the presentation explicitly states that this broad-based infrastructure growth is being led by a massive boom in liquid cooling for data centers.
And this is where the physical reality of our digital world just becomes undeniable.
Yeah.
For decades, the data center industry just relied on air cooling.
Right, big fans.
Basically, yeah.
Yeah.
You blow chilled air down the aisles of server racks, the hot exhaust air rises, and you cycle it out.
Which, I mean, that makes sense for basic web hosting or standard cloud storage, right? Think of a standard data center, like a basic family car engine.
Oh, that's a good analogy.
Yeah, air cooling works fine for the family car, but my understanding is that the chips powering modern AI, these massive GPUs running complex machine learning algorithms, they draw so much power that air is fundamentally incapable of cooling them.
Completely incapable.
They've become the equivalent of high-performance race cars. From a purely physical standpoint, air is actually a great insulator, which is the exact opposite of what you want when a server rack is hitting hundreds of degrees.
Right.
Trying to cool a high-density AI server rack with fans is like trying to put out a forest fire with a desk fan. It just doesn't transfer the thermal energy fast enough.
What's fascinating here is the underlying physics of that shift. Liquid coolants, and water in particular, have a thermal capacity thousands of times higher than air.
Thousands.
Thousands. So liquid cooling involves running microscopic channels of fluid directly to the silicon chips themselves.
Oh, wow.
Yeah, they use these cold plates that sit right on the processors. It captures the heat right at the source and physically carries it away through a closed-loop system of specialized hoses, manifolds, and precision chillers.
So it's heavily plumbed.
Very. That highly engineered fluid distribution system is exactly what nVent is supplying, and it's why they're seeing this tidal wave of orders.
So they're basically building the circulatory system for the AI revolution.
That's a great way to conceptualize it, actually. But this shift to liquid cooling is just one node in a larger web. The report explicitly cites 3 massive secular trends driving this:
Which are?
digitalization, electrification, and sustainability.
Okay, well, digitalization makes perfect sense. Everyone is racing to build bigger AI models, which require hotter chips, which require more liquid cooling.
Exactly.
But let's look at electrification. How does a utility grid upgrade factor into a cooling company's earnings?
Think about the power density required to run these new liquid-cooled data centers. A traditional data center might draw, 10 to 20 megawatts of power.
Okay.
The new AI campuses are drawing 100, sometimes 200 megawatts.
That is insane.
It is. You can't just plug a facility like that into the existing local power grid. It would literally melt the neighborhood's transformers.
I get it. So the power utilities themselves have to completely overhaul their own infrastructure?
Right.
They need new substations, heavy-duty switchgears, specialized protective enclosures, just to safely deliver that much concentrated electricity to the data center.
And guess who sells the heavy electrical enclosures, the bus bars, and the connection systems for those grid upgrades?
nVent.
Exactly. The source notes that strong growth in power utilities is running perfectly parallel to their data center growth. And then you layer on the third trend, which is sustainability.
Which feels like a contradiction at first glance.
Oh, so...
Well, these data centers are drawing massive amounts of power, so how is building more of them a sustainability play?
Right, I see what you mean.
Yeah.
It's because liquid cooling is vastly more energy efficient than traditional air conditioning. Yeah. Pumping massive amounts of chilled air through a warehouse requires an incredible amount of electricity just to run the HVAC systems.
That makes sense.
By targeting the heat directly at the chip with liquid, the overall energy required to keep the facility from overheating drops significantly. And since the big tech companies building these data centers all have strict climate targets, they are forced to adopt liquid cooling, not just for performance, but to reduce their overall carbon footprint.
So nVent is sitting right at the nexus of all this. Digitalization demanding the heat, electrification supplying the power, and sustainability forcing the efficiency.
Exactly. It's a perfect storm for them.
Here's where it gets really interesting, though. Because it's tempting to look at a 53% sales jump and just think, wow, nVent got extremely lucky.
Right.
Like they were just standing in the right place with a bucket when the AI liquid cooling rainstorm hit.
Right.
But looking at the portfolio transformation slides in this presentation, they engineered this position.
They did.
They purposefully expanded their total addressable market, their TAM, from roughly $60 billion up to $130 billion. You don't more than double your market opportunity by accident?
No, you definitely don't.
Yeah.
You execute a highly calculated expansion strategy. And for them, it was largely driven by two things: aggressive internal innovation and targeted M&A.
Let's look at the organic side first.
Okay. The presentation highlights that nVent launched 11 new products in Q1 alone.
11 new products in 3 months.
Yeah.
That is a software company pace of innovation applied to heavy physical infrastructure.
It's unheard of.
Right. To design, prototype, test, and manufacture new industrial hardware that fast means they must be using highly modular engineering.
And the result of that speed is quantifiable. The source notes that new products contributed over 20 points to their sales growth.
Wow. So a massive chunk of this record-breaking quarter is coming from specialized solutions they literally just brought to market.
Exactly, just to solve these emerging high-heat, high-power problems.
And on the M&A side, the deck specifically highlights the recent acquisition of the Electrical Products Group, or EPG.
Right.
It notes that this acquisition is actually performing ahead of expectations. So they didn't just buy market share.
No.
They bought a massive new capability set, integrated it into their existing global supply chain, and it's already over-delivering on revenue.
We should be careful, though, to not paint this as a completely frictionless environment.
Oh, for sure.
The presentation is actually very transparent about some severe macroeconomic headwinds they're navigating right now.
Right, because moving physical goods around the globe in 2026 is structurally more expensive and complex than it used to be. The reality check here is inflation and tariffs.
The guidance section of the deck explicitly notes an estimated $80 million incremental tariff impact.
$80 million.
Yeah. That is a massive extra cost levied just to move raw materials and finished products across borders.
And their internal costs are going up too, right?
Yeah, their corporate costs are rising. They are now projected at roughly $135 million.
So their baseline operating costs are absorbing massive shocks. But earlier, we established that their adjusted EPS jumped 63%.
Right.
How are they absorbing an $80 million tariff hit without their profit margins completely tanking?
This is where their operational execution comes into focus. Despite these severe headwinds, they maintained a 20.0% adjusted return on sales in Q1.
Maintaining a 20% margin while eating $80 million in tariffs requires incredible discipline.
Absolutely. And the deck attributes this to two specific strategies.
Right.
Aggressive price adjustments and operational productivity.
Let's start with the pricing power.
Sure.
My deduction here is that because the demand for liquid cooling is an existential requirement for these AI data centers, nVent essentially has ultimate leverage.
Oh, totally.
If you are building a billion-dollar AI server farm, you aren't going to let it melt down because the cooling manifolds cost 10% more this quarter.
Exactly.
So they have the power to pass those tariff costs directly onto the customer because the hardware is just mission critical.
That's the basic economics of inelastic demand. You have to have it no matter the price.
Right.
But they aren't just relying on price hikes to save their margins.
Mhm.
The second factor is operational productivity. They're aggressively leaning out their manufacturing processes.
Which means what, practically speaking, like on the factory floor?
Well, it means optimizing their own energy use. For one, reducing scrap metal during the stamping process, implementing predictive maintenance on their machines to eliminate downtime,
Oh, smart.
and highly localizing their supply chains where possible to avoid those cross-border tariffs in the first place.
Ah, of course.
By manufacturing smarter and squeezing more output from their existing footprint, they offset the rising corporate costs.
Which perfectly transitions into something else that really stood out in the deck. You mentioned localizing supply chains and reducing factory waste to save money.
Yeah.
We talked earlier about sustainability being a macro trend driving their sales, but a company profiting off the quote-unquote green transition really needs to operate sustainably itself.
Oh, otherwise the market eventually calls out the hypocrisy.
Exactly. The source includes specific internal milestones from nVent's 2025 sustainability report, demonstrating that they are applying those same operational efficiencies to their own carbon footprint.
Yeah, let's look at that 2025 report card. Because they achieved a 24% reduction in normalized CO2 equivalent emissions compared to 2024.
Wiping out a quarter of your emissions in a single year as a heavy industrial manufacturer is an incredibly steep drop.
It requires a fundamental overhaul of how you power your facilities and source your materials.
And here's the metric that really caught my attention. The presentation states that 100% of new products launched in 2025 used zero single-use plastic packaging.
Zero.
Zero. My first instinct when I see a zero plastic claim is to assume it's just corporate greenwashing for a consumer product like a shampoo bottle or something.
Right.
But we are talking about heavy electrical infrastructure, metal enclosures, liquid cooling chillers. To ship massive industrial hardware globally without a single piece of disposable plastic wrap or foam means they had to completely redesign their logistics.
Completely.
They likely had to shift to.
And that level of logistical reinvention speaks to a corporate culture deeply aligned with these goals.
Yeah, it takes buy-in from everyone.
The report notes that this culture extends to their workforce, highlighting an employee satisfaction and recommend score of 76, which the source specifically notes is 3 points above the global benchmark.
That's solid.
Furthermore, they achieved a goal of training 100% of all employees on their code of business conduct and ethics.
Now let me play devil's advocate for a second.
Go for it.
Why is an industrial hardware company taking up valuable real estate in a Q1 earnings deck aimed at Wall Street analysts to talk about employee ethics training and zero plastic packaging? Is this just a PR play to secure a spot in some ESG mutual fund?
If we connect this to the bigger picture, it looks much more like a hard-nosed sales strategy than just a PR play.
How so?
Well, these metrics and the external awards they feature, like being named one of Fortune's best workplaces, an Ethisphere World's Most Ethical Company, and achieving an EcoVadis Gold rating, they're highly effective competitive moats.
Ah, because of who their clients are.
Exactly. Think about the massive cloud computing giants, the global telecom companies, and the highly regulated power utilities that are driving that $2.6 billion backlog.
Right.
Those massive corporations have their own strict, board-mandated ESG targets. When a tech giant builds a data center, they audit the carbon footprint and labor practices of their entire supply chain.
Wow, okay.
They literally cannot afford the reputational or regulatory risk of buying hardware from a supplier with a terrible environmental record.
I see. So the EcoVadis Gold rating and the proven CO2 reductions actually de-risk the procurement process for their clients.
Yes.
If two companies are bidding on the cooling infrastructure for a massive new server farm and the pricing is roughly similar, the vendor with the verifiable sustainability record and the zero plastic packaging wins the contract because it helps the client hit their own climate goals.
It's a massive differentiator. They are selling sustainability infrastructure to clients who fundamentally demand sustainable operations from their vendors.
Yeah.
It creates a highly defensible market position.
So what does this all mean?
Whoa.
I mean, when you zoom out from the 53% sales growth and the billion-dollar backlog, this deep dive into nVent's Q1 2026 earnings presentation gives you a very tangible look at the physical build-out required to support our future.
Really does.
The cloud is not a cloud at all. It's a massive, power-hungry, incredibly hot network of machines on the ground.
Yep.
Behind every AI query, every streaming video, and every upgraded local power grid, there is heavy physical hardware. There are specialized cold plates, complex liquid manifolds, and heavy-duty electrical enclosures.
And there's an entire global industry making billions of dollars successfully engineering the physical architecture to keep the digital world from burning itself up.
Exactly.
It grounds the entire digital revolution in absolute physical reality.
Yeah.
And, it leaves us with a fascinating challenge to consider.
What's that?
We've seen how standard air cooling fundamentally failed to keep up with modern data centers, which forced this explosive shift to specialized liquid cooling. But as AI models become exponentially more complex and these massive server campuses grow even hotter, you have to wonder, how long can the physical supply chains of these advanced chemical coolants, the massive local water infrastructure required to support them, and the power grids themselves keep up?
Wow.
At what point does the physical challenge of moving heat away from silicon become the ultimate bottleneck of human technological progress?
That is a wild thought. It really makes you look at the hidden systems of the world differently. I mean, you can't just keep building infinitely hotter engines without eventually running up against the laws of thermodynamics.
You really can't.
Well, thank you so much for joining us on this deep dive. We hope it gave you a new perspective on the heavy metal reality powering your digital life. Keep questioning the invisible systems around you, and we'll catch you on the next one.